Let's say it's 2008. Markets are down, people are panicking. The headlines scream worst recession since the Great Depression. The graphs look like ski slopes, and your brain is lying to you. It's not just the economy that's crashing, it's your decision-making. Because in a bear market, the biggest threat isn't the market itself, it's you. More specifically, your own cognitive biases. Today, we're going to unpack what those are, how they cloud thinking, and why they make us buy high, sell low, and repeat until broke. This is the psychology of bad investing and why it's terrifyingly predictable. But first, what is a bear market? A bear market is when a financial market declines by 20% or more from recent highs and stays down for at least 2 months. It's called a bear market because bears swipe their claws downward. A fitting metaphor. Bear markets aren't rare. There have been 14 in the US since World War II. They come, on average, every 5 to 6 years, last about 13 months, and recover in about 2 years. But what's truly dangerous isn't the bear, it's how people react to it. Because the human brain was not designed for the stock market, it was designed for survival on the savannah. And unfortunately, the instincts that help us avoid lions get us killed on Wall Street. It's under bear markets that the cognitive biases can do more damage. So, let's check the main biases, or behavioral patterns, or traps that we should be aware of.
Loss aversion, the first trap.
Imagine this scenario. You invest $10,000. A few months later, it drops to $8,000. You feel awful, but why? It is because of loss aversion. A foundational concept in behavioral economics, loss aversion says that people feel the pain of losses about twice as strongly as the pleasure of gains. In other words, losing $2,000 hurts way more than gaining $2,000 feels good. So, when your portfolio drops, your brain screams, "Get out! You gotta escape now!" It feels like you're bleeding. But markets are not bleeding wounds. They're cycles. And selling during a crash locks in the pain, permanently. Daniel Kahneman and Amos Tversky, the psychologist who pioneered this theory, found that most people would rather not lose than win, which makes rational investing irrationally hard. Herding bias, the stampede. Now picture this. The market drops 10%. You're nervous. You open CNBC, everyone's panicking, social media is chaos. Your coworker says he's selling everything. Suddenly, you're no longer asking, "What should I do?" but thinking that you don't want to be the last one on a sinking boat. This is herding bias, the tendency to follow the crowd, even if it leads off a cliff. In nature, herding keeps animals safe. If the group runs, you run. You don't ask why. In markets, it means people sell en masse, prices fall further, and panic becomes a self-fulfilling prophecy. The bear gets fatter. Herding explains bubbles and crashes. It's why housing prices soared in 2007 and crypto in 2021, then both imploded. Because in finance, the herd doesn't just follow trends, it creates them. Anchoring bias, the fixation. Let's say you bought a stock at $100, but it drops to $60. You hold. You say, "I'll sell when it gets back to $100. This is anchoring bias, the tendency to fixate on arbitrary reference points, like the price you paid, even if that has nothing to do with what the stock is actually worth. Your brain treats $100 as a meaningful target, but it isn't. The market doesn't care what you paid. This bias causes people to hold on to losers, hoping they'll come back. Sometimes they do. Sometimes they don't. You're emotionally anchored to the past while the market moves on, and that fixation can sink your whole portfolio. By now, you may be thinking that some biases contradict themselves, and you are right. We'll talk about it ahead. Overconfidence bias, the invincibility illusion. During bull markets, when prices are rising, everyone feels like a genius. Stocks go up and so do egos. This sets the stage for overconfidence bias, the belief that our knowledge or skill is better than it really is. Research consistently shows that the average investor underperforms the market, largely because of overtrading, buying and selling too often, with too much confidence. In bear markets, this becomes even more dangerous. Overconfident investors may try to time the bottom, chase rebounds, or double down on bad bets. It feels brave, it feels smart. But it's gambling dressed as strategy, and the house always wins. Recency bias, the trap of the now. Imagine watching the market fall for 4 days in a row. What do you expect for day 5? Most people say, more of the same. That's recency bias, the tendency to believe that recent events will continue into the future. It's why people think bubbles will keep rising, or why they panic in crashes, assuming the worst isn't over. During bear markets, recency bias makes investors abandon long-term plans because the short term feels like forever. But markets are cyclical, not linear. And what just happened is not a reliable predictor of what's next. Yet the bias is hardwired. It's how our ancestors remembered where the lion was yesterday. The S&P 500, though, is not a lion. It can move much more erratically. Survivorship bias, the success illusion. When markets recover, we often hear, if you'd bought Apple at the bottom, you'd be rich. Yes, but that's survivorship bias, focusing on winners while ignoring all the failures. We hear about the stock that bounced back, not the 10 that didn't. We talk about Warren Buffett, not about the thousands who tried and failed. This distorts our perception of risk. It makes bear markets look like opportunities, if you just pick the right one. But in reality, many companies don't survive bear markets, and often, there is no way to know ahead which ones will make it. Lehman Brothers, Enron, Blockbuster. They didn't bounce back, they disappeared. Survivorship bias turns investing into a game of selective memory, and that memory is often wrong. The narrative fallacy. We love stories, and in times of chaos, our brains demand them. Why did the market crash? Inflation? Interest rates? Aliens? This is the narrative fallacy, our tendency to explain complex phenomena with simple, compelling stories, even if they aren't true. Markets are vast, chaotic systems with millions of variables, but we reduce them to digestible plots when we say things like, this happened because of that. Narratives feel good. They give us a false sense of understanding, but they lead to false confidence. In reality, market movements are often random, but random is unsatisfying. So we create stories, and sometimes those stories lead to bad decisions. Confirmation bias, echo chamber economics. You're worried about the market, so you Google, is a crash coming? You find 10 articles that say yes. You feel validated. That's confirmation bias. Picking information that supports your existing beliefs and ignoring everything else. Because if you had Googled, is the economy improving? You would also find 10 articles agreeing with this sentence. But bears read bearish news and bulls read bullish news. Everyone thinks they're right, and no one listens. Confirmation bias reinforces fear or overconfidence, depending on your perspective. It makes rational analysis nearly impossible, because people are not looking for truth. They are trying to win an argument. Endowment effect. You are not your stocks. You own a stock. It drops 40%, but you still believe in it. You say, I know this company. I've followed it for years. I'm not selling. That's the endowment effect, valuing things more, simply because you own them. Objectively, the stock might be a sinking ship, but emotionally it feels like a friend. You're attached. This bias makes us hold on to losers and miss better opportunities. It's not loyalty, it's psychology, and in bear markets it can get expensive. The trap of contradictory biases. At this point, you might have noticed that some of these biases contradict each other. Loss aversion tells you to sell to avoid pain, while anchoring bias tells you to hold because you want to break even. They pull you in opposite directions. So, which one is correct? The answer is neither. Because this isn't a logic problem, it's a psychology problem. These biases don't activate based on facts, they activate based on feelings. The fear of losing more, the hope of recovering, the ego boost about being right, and the memories of past mistakes. Different biases kick in depending on the situation and emotional state. So how do we avoid traps? 1. Diversification. Don't bet the farm on any one stock. Spread your risk. 2. Dollar cost averaging. Invest the same amount at regular intervals, consequently buying more when prices are low and less when high. It removes emotional buying. 3. Have a plan. Decide your strategy before the bear shows up and stick to it. 4. Write down your reasoning. When you make a trade, record why. Revisit it later. You'll catch patterns in your thinking and your biases. 5. Get comfortable doing nothing. Sometimes the best move is no move. Bear markets are tests of temperament, not intelligence. Warren Buffett said, "The stock market is a device for transferring money from the impatient to the patient." In other words, the market will recover. Will you? Closing the loop. Cognitive biases aren't flaws. They're features of the human brain, built for survival, not stock picking. But recognizing them is the first step to escaping them. Because in the market, your worst enemy isn't inflation or even the bear. It's the lack of planning. So next time the market turns red, take a breath, zoom out. And remember, you're not fighting the market, you're fighting your instincts. And that's a fight you can win. Thank you for watching Into the Loop. If you liked it, I think you'll like these too.